Well, good afternoon, one and all. I want to welcome you to today's event, Earnings Reaction Portfolio Sneak Preview. It's Monday, February 7th. You got John Hopkins here. Tom Bowley going to jump in just a few minutes, quick minutes here. Want to welcome anybody who's new to Earnings Beats. Appreciate you taking the time to stop by today. Hopefully you'll find it educational. As usual, we will be recording this event. For some reason, you can't be here for the entire time. No sweat. Aaron does such a great job of, well, just a great job of everything, but getting this out to our members and, very in a very useful format. So that will be forthcoming, I'm sure, later tonight. Got some other events coming down the road. And I think a change in one of the events that was supposed to happen later this week, and Tom will get into that. But certainly, if you're somebody who's considering a trial membership, this is a great time to do it, because we have this particular event tonight. It's what we call a public event, open to all members of the Earnings Beats community. But we've got some really important ones coming up. You can just go to our website and look in the calendar, and you'll see that we've got a number of events coming up in February that are for members only, and that includes anybody in the trial membership. You can take out a trial membership for $0 for 30 days. We can't make it any cheaper. So it's really a good and timely period really to consider that. Anyways, I want to, make sure we get done with this in a timely fashion. If there's questions, I'll try to answer them throughout the event. If we have time at the end, Tom can field a few of them. But let's go ahead and get Mr. Bowley in here and get this thing rolling. Hey, Tom.
Hey, how you doing, John?
I'm doing pretty good. I'm kind of referring to this current period as a wacko market. It's, you see futures up overnight or down, and the next morning it changes. NASDAQ goes up 100, then it's down 100. These are kind of moves that you see sometimes take a while to develop, but they just seem kind of fast and furious right now.
Yeah, well, I mean, I think, this is something we talked about, or I talked about back at the end of the year. I mean, this is what I was looking toward in 2022. We had sentiment from an options perspective. Sentiment was just way too bullish. And when you go from bullish to bearish, you go through a lot of periods of volatility. And so you can't just, snap your fingers and be there overnight. This is the kind of market we have for now. Dangerous to trade, especially if you catch yourself chasing all the time, where you kind of watching the market and you see, oh, it's making a big move to the upside. I better get in. And you jump in. Next thing you know, you're back down 3%, 4%, 5%. And then you're like, oh, I knew it was going to go down. Let me get out of these longs. Let's go short. And then you get that reversal back to the upside. I mean, it literally whipsaws you back and forth both directions. So you got to be careful and really pick your spots where you trade. And, I think in the near term anyway, from the way I'm approaching the market, is the bias is to the downside until proven otherwise. And we keep seeing that. I wrote an article over the weekend about how, when you're in downtrends, a lot of times what you see is morning strength and then afternoon weakness. I mean, look at what we had today. We had some morning strength, saw a little bit of strength, or, pulled back, went into negative territory. And then we had some more strength during the day. But how did we finish? Finished almost right on the lows again. With a lot of selling in the last half hour, 45 minutes. So, it's going to be a really tough market to try to navigate. And I think now is a good time to kind of maybe sometimes just sit on your hands a little bit more, hang on to your capital, do some studying, learn more about the market. And, there'll be brighter days ahead. I think the second half of this year, especially fourth quarter, could be really strong.
All right. I think we're ready to just take it away.
All right. Sounds good. First, I just want to welcome everyone. Appreciate you coming by on a Monday afternoon. I don't know where everyone else is, but I can tell you right here in just a little south of Charlotte, North Carolina, it is a dreary, cold day. We have highs today, I don't know, around 40. We're pretty well into the south, but we only have highs around 40 and rainy, and it's just nasty out. I was outside, went to my Starbucks today, and it was just one of those bone chilling kind of days. And I know some of you maybe from the north, maybe below zero temperatures are like, oh, you have an outdoor party, 40 degrees. But it all depends on your perspective and what you're used to. And 40 and rainy is not what I'm used to. I'm a golfer. I like to get out and play some golf from time to time, and I don't do that. There are people at my club, they go out and play all the time in this. I don't know how they do it, but anyway, that's probably for a different webinar. Anyhow, we got a lot of stuff to cover tonight. Again, just want to thank everybody for coming in. A few of the things that we're going to cover tonight, just kind of run through the agenda. We're going to talk about, what to expect with earnings. We actually issue or we provide to our members and even to some of our community members, our digest, our free digest community members. We provide some chart lists. And if you're not familiar with these, you should get familiar. I think they will really help you. And if nothing else, just kind of look at them. I think it's fascinating, kind of watch them, where the money's going and so forth. So I'll go through a little bit of those chart lists with you. Then we'll get into earnings to date. I'm going to bring out a spreadsheet. You all know, many of you know, I'm former practicing CPA, 20 years. And so I love spreadsheets. I love to analyze. And Matt Townsend here at Earnings Beats works with me. He does a lot of the detail work on this earnings to date spreadsheet, if you will. And I'm going to show you some of that. And we will include this spreadsheet on our website, for those of you who are members to download. So if you're not already a member, that's one reason you might want to consider becoming a member. And then we will wrap up with just taking a look at how we put together the earnings reaction portfolio and talk a little bit about the draft that we're going to have. I do want to mention now, and I'll probably mention again later in the webinar, but we are going to move the draft. We were going to do it on the 10th, which is when we did it 3 months ago. But I think we're going to move it to the actual date of our other portfolios, which will be on the 21st of February. So we're already doing our model portfolio, our aggressive portfolio, our income portfolio, and our strong AD portfolio, strong accumulation distribution portfolio. Those 4 will be announced on Monday, February 21st. And rather than do this and just have an extra webinar, decided to go ahead and include the earnings reaction portfolio, the 10 stocks that are going to make up that portfolio. We will announce on February 21st instead of on February 10th. And, in thinking about it, it just gives a couple more weeks worth of earnings to analyze, to really come up with the companies that we want to have in there. So I think it's just makes more sense to wait a little bit and get through more of the earnings reports. So with that, let me go ahead and get this thing started here. One thing I'll tell you, though, before we get started is one of the things I sent out to members earlier today. In our daily market report, one of the things I talked about, because trying to predict this movement back and forth, just like John was mentioning, I mean, it's so crazy. The movements, you think you got an uptrend, all of a sudden it's just right back out from under you and you're going lower. And, it's not like you can feel like you can walk away from your computer for 20 or 30 minutes. I mean, sometimes you're talking, 1 and 2% moves in the entire index in 30 or 45 minutes. So, you've got to, if you're going to trade, you've got to be paying attention, keep your hands on the wheel, of what's going on. But anyway, one of the things I talked about in the daily market report, which is a report that we do every day for our members at Earnings Beats, I said how difficult it is to try to figure out in a highly volatile market where it's going to go in the next few hours. I can kind of look at the big picture and say, okay, I think we're in a downtrend, watch these levels, and kind of from a wider perspective, kind of have ranges of support and resistance to watch. But intraday, I mean, here's the intraday chart of the S&P 500. I mean, you go down in the morning, a huge gap down on February 3rd, which was last Thursday. And then, probably 20, 25 point move back up. And then next thing you know, an hour later, you're back down 30 points. And then into the close, last 2 hours into the close, another 40 points tacked onto that. And then Friday, you start off a little weak, you come back up, show a little morning strength. Then it looks like you're breaking back down again. Then by the, over the next 3 or 4 hours, you have this huge rally, almost 100 points on the S&P 500. It looks like, hey, we're going to finish strong for once. Let me jump in. And then 30, 40 minutes later, you're taking this big tumble again back down to the downside where you lose 1% in the last 20 or 30 minutes. So this is what we've been dealing with. But one thing that I like to follow, and it's certainly not any sort of a guarantee, especially on a short-term basis, but I like to follow the XLY XLP ratio and just see what's going on. Just see if it's confirming what I'm seeing on the S&P 500. And so last week, and this was back on Wednesday, Thursday, right here, or Tuesday, Wednesday, actually, you can see the S&P 500 was moving up. Actually, I'm going to go back just a little bit further than this. Let's go back, 7 days instead of 5. But you see how the S&P is moving higher, and you see how the XLY, XLP also moving higher. Well, then we got into the second half of the day on the 1st of February, which was last Tuesday, and then the second, which was Wednesday. And you see how the S&P just kept going higher. This right here doesn't look any different than, back on that Monday or even the Friday before, we finally hit some buying at the end of the day. I mean, we have a nice little uptrend going. You look at the S&P 500, you don't see anything different. Look at the ratio over the last day and a half, or this day and a half on February 1st, which was Tuesday, and February 2nd, which was Wednesday. Don't you see the difference here? Now, instead of consumer discretionary outperforming consumer staples, which is the aggressive versus the defensive area of consumer stocks, instead of moving higher to support this move to the S&P 500, all of a sudden we turn lower for a day and a half, suggesting you better be careful. And then what happens on Thursday morning? We get the big drop. I think that was Facebook coming in with the big drop. And then since then, we've been going mostly sideways. But look at today's afternoon action. Look at the S&P 500 trying to rally back. That was a 1% move over 2 or 3 hours. We might think in terms of the volatility we've been seeing, maybe that's not such a big deal. But 1% intraday is a pretty big move. But look at what the XLY, XLP was doing. It just kind of went sideways. Once we got to about 1 o'clock, we didn't move up anymore with the market. And then, of course, as soon as we started to go down, look at that XLY, go right back down to a new low. So I do think it helps to give you some clues. It's not, I can look at this and say, well, here we were going down, but then the XLY was going up. So, well, the S&P did come back up after that. But what about this morning? We had early strength, a lot of gap ups in some key areas of consumer discretionary, especially Amazon. Amazon had a big move up early. Tesla was up early. And so that was leading the XLY to the upside. But look, by the end of the day, both Amazon, Tesla, and many of the other consumer discretionary names coming back down, just not performing well versus consumer staples. Anyhow, I just wanted to point that out because that's a question that comes up a lot. Can we trust anything? And the answer is no. I'd be careful trusting any move in either direction right now, intraday. It's just whipsaw. It's, market makers taking advantage of a lot of folks, in my opinion. In the big picture, long term, these moves back and forth aren't really doing anything. Watch 4,300 to the downside on the S&P. Watch 4,600 to the upside. Those are the two levels personally that I'm watching to reevaluate. As long as we're in this range, I believe we're in a downtrend and we end up breaking down to the downside. If we break up above 4,600, I'm going to start to look at some signals and see if maybe there's something else taking place in the market. Maybe I'm wrong. Maybe it's not going to go below 4,300. But based on everything I'm seeing right now, I think we go lower. Anyway, I just wanted to bring that up because that's a question that comes up from time to time. I thought maybe it was timely given the market conditions right now. So what do we expect with earnings? Well, let me just tell you first that we have some chart lists that we provide to our members. Now, this is our upcoming earnings relative strength chart list. So this encompasses the majority of companies that are going to be reporting earnings all week. And we try to get this out It came out a little late this week. I think it was updated on our website a little bit after the market opened today. Normally, we'll try to have this out to everyone on Sundays so that they can, kind of be preparing and looking ahead. But the number of earnings that came out this morning, there were only 8 companies on this list. And if you go to the edit, you can see how many charts are on here. Right here, 332 different companies are on here. So only 8 of them were reporting this morning. So it wasn't that big a deal coming out a little bit later. But the way that we set this up, and there's a couple of things that you need to know about this chart list. First of all, this chart list takes a long time to put together. And I know Matt Townsend, who works with me on this, could attest to that. I mean, it's very tedious. You can't just put in, the names of the companies and then say, here, just do it relative to its industry group. It doesn't work that way. If you do one relative to food products and then bring in the next one, which is a medical equipment company, it's not going to set up the same. You have to manually do a lot of these annotations and so forth with these different charts. So anyway, it takes a long time to do 332 companies manually. Takes a lot of time. So we do reserve this chart list along with a couple of others to our annual members, people who are committing to us for an extended period of time, because this is a lot of time and effort and work to put into some of these chart lists for folks who maybe have no intention of committing and just taking a lot of work that we do. So that's the reason for it. I think it's tremendous. I think it can be a tremendous part of your trading arsenal. But you have to understand what it is and how maybe to consider using it. So let me just talk about that a little bit. First of all, when we put this list together, that first number, you see this chart list is put together in number order. So we go from 1,000 to 1,007, and then we jump up to 1,500, and we go 1,500 all the way down to 1,525, and then all of a sudden we jump to 2,000. So let me explain a little bit about this. The first number you see is the day of the week. That's when the companies are going to be reporting. So if you have a 1 in front of the name, then that means it's reporting on Monday. If you have a 2 in front of the name, it's Tuesday. 3, all the way down here, Wednesday. Any of these that start with 3 or Wednesday. 4, Thursday, 5, Friday. Pretty simple. Now, within the ones, we have, you can see 1000, 1001, all the way to 1007. And then all of a sudden we have 1,500. Well, anything starting 1 with a 0 after it, the 0 is before the market opens. If it has a 5 after the 1, that means it's Monday and it's after the close on Monday. 0 with the 1 before the open on Monday, 5 with the 1 after the market closes on Monday. When you go down here to the 2s, you got 0s, meaning morning. This is Tuesday, morning before the open. When you get to 2,500, these are companies that will be reporting on Tuesday after the close. So there is a method to our madness with these numbers, that if you sort this chart list, if you just sort it based on the name and it comes up in this number order, you can quickly identify when these various companies will be reporting simply based on the number that's before them. So that's number 1, really important. Number 2 is these are all relative charts. When we pull up this chart, Tyson's is the number 1. They reported this morning. And when we pull up Tyson Foods, it's going to be relative to its peer group, its industry group, which is food products. So TSN : $DJUSFP, this simply gives us a 1-year chart showing us how Tyson Foods has traded relative to its industry peers. And you can see going into earnings, and I think this is really important, going into earnings, this was a company that was favored relative to its peers. So when I see this, the first thing I think of is Wall Street is endorsing Tyson Foods. They've done their homework. They've gone out, they've met with management, they've come back in, and on a relative basis, the stock's going up versus its peers, which tells me the Goldman Sachs of the world, probably has gone out, figure they like what they're hearing. The business model looks good. They're, doing better maybe than their competition, whatever it is that they talk about, I think gets reflected in these charts. So what I would expect when a stock like this is uptrending, I would expect a good report. Now here we got not only a good report, a really good report, but we also got a great reaction. You don't always get this great reaction. I want to make sure I'm clear about that, because some might look at this and say, oh, we're trending up, I'm just going to jump in on the long side. Sometimes you get hit because you get a buy on rumor, sell on news. So sometimes you get these companies that do really well heading into earnings. They post great numbers and then they gap down. So just because it has relative strength doesn't necessarily mean you're going to get this kind of reaction. However, when I see strong relative strength, I'm thinking they're going to have great news. I'm thinking their report's going to be solid. And if I'm right, then I would be looking for any kind of a pullback, maybe to take a position in the stock. Because like I said, some companies buy on rumor, company comes out with great news and it pulls back and you get an opportunity to buy on the pullback. In this case, Tyson just took off, got great numbers, and it just took off. But I think that relative strength was very meaningful in this case. Whoops, let's go back here. So every one of these companies is set up in, based on their relative strength to their industry group, not to the S&P 500. And so you can actually, once you download this chart list into your account, if you're a Stock Charts member, if you're a non-member at Stock Charts, you can still download this chart list, but you have to look at charts one at a time. If you're a member, then you can start to sort and scan and do it. Well, scanning against relative strength is difficult. I don't know if you can do that, but you can certainly put this in summary form. And let me show you what this looks like. So here, this is an intraday period. We could look at this whole list and say, of these 332 companies, which company did the best work today on a relative basis to its industry peers? And if I click on that percentage change, you'll see Peloton was number one. Well, if you followed the stories over the weekend, a lot of companies apparently interested in buying Peloton. Personally, I doubt it's going to happen, just because insiders own so much of the company that, you're not going to watch your company lose the kind of money that this company has lost in terms of their stock price. I'm not talking about profits. I'm talking about their stock price. You're not going to watch your company go down 80%. If you still believe in it, you're not going to simply hand it over for somebody to pay you a 10% premium or 20 or 30 or even 40% premium. If you believe your company, Peloton, which is $30 a share, is going to get back to $100 a share, you don't want to sell your company. So somehow there's got to be enough pressure put on those insiders to where they would be willing to sell, or that they feel like they have to sell. We'll see what happens, but I'll be very surprised if Peloton gets bought out. That's just my opinion. But anyway, that's why this stock is on the top of the list. Some of these others could have been because of earnings today. There's Tyson, there's On. I think Spirit also reported this morning. Or no, they report Tuesday afternoon. Anyway, I don't know if there was news out on Spirit. I think that's Spirit Save. I know airlines were having a pretty good day, and Spirit made a nice jump there on a relative basis. Now, overall, see, now this one would bother me, because this is a stock that's been going down relative to the airlines. And prior to today, I don't know what the news was today. I'd have to go look. But prior to today, this is a company that was not performing very well. So this might be one of those situations where someone gets whipsawed and you jump in having a great day today, and then all of a sudden earnings come out tomorrow after the close. And and then they go into talking about all the stuff that created this relative weakness in the first place. So I would be careful with a stock like Spirit Airlines, simply based on the way it's been trading prior to today. But, Tyson's was strong. How about On Semiconductor? I mean, if we pull this up, look at the stock relative to semiconductors. We shouldn't be surprised it's breaking to a new high with its earnings report. This is a company that's been trending higher relative to semiconductors for months. It's been a great company. The problem with On Semiconductor is not it itself, it's the whole group. Semiconductors have been getting killed. And so as a result, you've seen pretty big selling in January, but here we go with earnings right back to a new all-time high. or I shouldn't say all-time high, 52-week high. I haven't looked to see if that's all-time. But anyway, this is a really strong move here on. So let's see, what else do we have? Well, the other thing I would do, and by the way, this new relic is going to be one I find very fascinating, because it had such a huge move with earnings back in November, pulled back, but it actually went to a new 52-week high relative to software. Doesn't mean that it's been going higher. It's just that it's been doing better than its software peers. Does that mean it's going to translate into a big report tomorrow? I mean, I would give that a better chance if I'm sitting there trying to evaluate, do I want to hold into earnings or not? I prefer this kind of a look rather than the alternative of where the stock is going down in near 52-week relative low. So this would kind of paint the picture that, hey, if I was somebody willing to take a risk, maybe this chart's enough to tell me take the risk. Now, if somebody decides to buy in based on this discussion, that's your risk. That's up to you. I'm just saying that this is a chart that, to me, paints a picture that Wall Street is at least within the software space believing that New Relic is still one of the stronger stocks in the space, based on the fact that it's sitting up here near 52-week relative high as it goes into its earnings report tomorrow. Okay, let's see, what else do we have on here? So one company coming out on Thursday is Cloudflare. Now, this was a huge winner for a long time. And then when all the growth stocks just started getting hammered, you can say that it was worth it, or that it's that they were, they should have been getting hit to the downside. I think this is a massive overreaction to the downside based on what I think will be temporary inflationary concerns and maybe a rate hike or two, but I don't think it's going to be long term. I think this is a major overreaction. So I think Cloudflare could do extremely well when things settle back down again. But is this relative move here right before earnings? Is this a little head fake? And then we get the news that we've been expecting with all this relative weakness coming out on Thursday? This one, would I hold Cloudflare into earnings? Personally, I would not. This is the kind of company that can get slammed if they miss their numbers or if they lower their guidance. Yeah, I know this is one that if they come out, kind of like Snap the other day, if they came out with better than expected results, you get this big move to the upside. All I'm saying is don't ignore the big risk to the downside. Yes, you have possibility of huge returns to the upside, but we've already made a little bit of a move. We've seen 3 months of selling, big selling. I would be careful as this earnings report comes up. Now, the other thing you can do with this chart list is look at the 1 month returns, because this to me is more important, because it's giving us, there we go. It's giving us which companies over the last month have been trading the best relative to their own peer group. So Zynga, now when I pulled this one up though, I think Zynga on an absolute basis, let me see, here's the chart, but if I pull up the absolute chart, I think there was a huge gap up. And I don't know what this gap up was. So this wasn't steady buying. Something came out news, and I remember something in the news about Zynga, but it's been a while, so I don't remember now. I got so much stuff going on inside my head. It's hard to sort between all of it sometimes. But I do remember Zynga having some news recently. You can see the huge move up from $6 to $8.50, $9 as a 50% gap up. That's where all this relative strength came from. It was from that news event, not necessarily Wall Street accumulating over a period of time as we head toward earnings. It's a little bit of a difference there. But these are the ones that I would at least, begin looking at to think, okay, maybe, just maybe, these are leaders over the last month, and maybe 1 month's not long enough. Maybe you might think, well, I want to know what's been going on over the entire quarter. And so, we switch this to 3 months, and now we get a different, look at New Relic right there. Third on the list out of 332 companies. That's really strong outperformance relative to the software group. VCRA has done even better. Let's take a look at that chart. Look at VCRA relative to software as it heads toward earnings. Do you think this is just some random buying that's taking place, or do you think Wall Street has met with the company and they love what's going on in the company right now? I think it's the latter. I think this is a company that absolutely could do well. If that looks like a gap up, but we've been going up for a period of time. I think if we look at the chart here, VCRA, well, actually, they may have been bought out. Never mind. Scrap everything. They were already moving up, and maybe they were moving up because of the rumors of being bought out. But Vocera Communications bought out, so that's another one. Again, that's why you have to pull up the charts, to look to see if there's some kind of confirming signals on the charts. But the better these companies have performed heading into the earnings, this is where I would start my research. If you like to consider going in on stocks before their earnings, if you were that kind of a risk taker, or excuse me, sometimes, hold on one second. Sometimes what I do is I just want to know the companies, these companies that are leaders heading into earnings. And then I watch the earnings. And if the earnings are strong, then it's kind of confirming what Wall Street was telling us. But sometimes you get that sell on the news. So you got a great company. They came through, they reported great numbers, and then they sell off. And those who were holding in the earnings just scratching their head saying, why is my company going down? They just had a great report. Well, buy on rumor, sell on news is something that you always have to be aware of in the market. So sometimes that sell off after earnings can be a great opportunity to get in. That is essentially what I wanted to go over with this upcoming earnings relative strength chart list. Now, again, remember, all these charts are based on relative strength. You're not going to see the absolute charts on these charts. What you would have to do, like VCRA is reporting on Thursday after the close. Okay. So what I can do to see the absolute chart is, and this we provide these chart lists to everybody, the entire public. Anybody can come in, even if you're not a member at Earnings Beats. If you're a EB Digest subscriber, that's all it takes, just a free subscription to our Earnings Beats Digest newsletter. That's no credit card, unsubscribe at any time. That's just being part of our community. Here is the upcoming earnings for Thursday after the market closes and Friday before the market opens. Or actually right here, Thursday after the close, Friday before the open. So this is where we should see, VCRA, or let's see if there's another one. Let me pull up a different one since we already know we don't need to look at that chart. Let's look at New Relic's absolute chart. And that's Tuesday afternoon. So again, we come in here and we'll go to Tuesday afternoon, that's Monday. There's Tuesday afternoon, Tuesday after the close, Wednesday before the open. That's how these upcoming earnings are sorted and put together. So, and the reason we do this is come Wednesday morning, as soon as the market opens, you can pull up this chart list and just put it into intraday form. And it'll give you the companies and how they've reacted to their earnings. Now, this one, of course, isn't going to do that because they haven't reported yet. But if I went back and showed you the Monday, the one for this morning, there were only, these 8 companies on here, but you could have pulled this up first thing this morning, 9:31, and gotten a quick analysis of all the companies reporting. What's the market reaction to all of them? CRNC, by the way, if you looked at this chart, here's CRNC. This stock's been downtrending for a while. Look at the relative strength on CRNC versus software. It's been downtrending. Wall Street has been throwing this stock into the garbage heap for the last year or more. Would I hold this stock into its earnings report? Zero chance. Less than zero. There's no chance I would ever hold a company into earnings when it's trading like this. I don't care if it gaps up 50%. That to me is just not worth the risk. And look at the stock, it gaps down. It's already been going down. Maybe some folks look at it and say, oh, it's already gone down so much. How can it go down anymore? Well, you found out 31% today, $20 at the open. got to be careful with these companies that are showing relative weakness. So, you've got opportunities, I think, where we can be looking at, if you like to trade around earnings, that is. Some of you may, some of you may not. If you don't, that's fine. I still think it's a great, if you're looking maybe just to create a watch list, what you could be doing is just looking at some of these companies that have some of the best reactions right after earnings. I mean, you could take a screenshot of each one of these, sort them from top to bottom, and maybe just take the top 10 each day and just take a screenshot at 9:35 in the morning, and then go back and look at those, that later that day or next week or whatever. See what's, going on. They had a great reaction. If this earnings came out strong, maybe a week later, you might be able to get them on a pullback, maybe back to where they gapped up, gap support. Anyway, there's all kinds of different ways you can use this, but I think it's a fascinating way to approach earnings season. And I think these are great chart lists, great products, great research for our members, and all of this work that we do in putting these together. And again, I'll mention Matt Townsend, because he does a lot of this work. You can download into your stock charts account literally in seconds. Let me show you. Let's put this in edit form. Anytime you have a chart list in edit form, you can go over in here and hit this new list. So let's just say, let's say we didn't already download this. So I'm just going to create basically the same list, except I'll make it a different number or something. So 010911 dash upcoming earnings 27 BMO. Okay. All right. So I just created a new chart list. There it is. So, or actually that is, yeah, there's my new chart list. So now when you go into earnings beats, and if you go from the earnings beats digest newsletter that we have, we'll have a link that'll take you to the chart lists where you can find all of these chart lists. But if you're a member, you can just go to the chart list page and scroll all the way down the bottom, and there's your upcoming earnings chart list. So now for Monday, I just created that list. I want to show you how easy this is. I've already downloaded this, so it's not going to ask me for the password because I've already given it the password. But if this is the first time you're downloading one of the chart lists, always copy this password, because stock charts will ask you for a password. It's not stock charts password. It's not your earnings beats password. It's the specific password that we provide for the link. So always make sure you highlight this and copy it. On a Mac, it's Command-C. And then when you click the link, it'll come up and ask you for the password. Now, this time it's not going to, because I've already downloaded this list. But right when you click it, something will come up. To ask you for the password, you just paste it where it asks, hit the enter, and then it'll bring you to this page. Okay. Now, from this page, if you're a non-member at Stock Charts, you're not going to see this green button over here. You're not going to be able to save to a chart list because you're not a member at Stock Charts. Instead, what you'll be able to do is you'll be able to look at each one of the stocks just like this, probably with ads along the way, because, obviously they're trying to make money and you're not a member. So you're going to see some ads, but you'll be able to go through and look at all the charts. I mean, that is good, but it's not nearly as convenient as hitting save to chart list and then coming over here, hitting replace list. Remember, I just set up that upcoming earnings chart list. Here it is, 010911. That's the one I just set up. I'm going to replace that list with these charts, and boom, save results. Boom, just like that. How long did that take? All of our research at Earnings Beats downloaded into your stock charts account, just like that. Really cool. And then you can, use it however you want. So that's basically what I wanted. I just want to make sure everybody's aware of these chart lists and how you can prepare for earnings season before the reports come out. So now let's move on to what's happened so far in earnings season. So earnings to date. And the way we're going to do that is using an Excel spreadsheet. So if you're not a big fan of spreadsheets or math or numbers, this maybe won't be as appealing to you. If you are a fan, if you're an Excel geek, you're going to love this spreadsheet. So what we have first is the data. And in this data, we have the date of the earnings report, and this is in chronological order. So here's 118 before the market opens, 118 after the market closes, and then 119 before the market opens. And remember, 118 after the market closes and 119 before the market opens, these are all companies that'll be in on one chart list. Why? Because they're both reporting earnings from the 18th close, after the 18th close and before the 19th open. So these are all going to show initial market reactions all at the same time. So anyway, chronologically, we have all of the earnings reports listed here. All right. All the way through so far, February 4th. So they don't have today's, or maybe they have this morning's. Let's see here. Yeah, this morning's, the start of the spreadsheet is on here, but all the way through last week, you can see, and this is a lot of work to put all this information on. We give you before the market opens or after the market closes. There's your ticker. Here's your sector: financial services, industrials, technology, blah, blah, blah. Here's your industry group. These are the estimated earnings. This is what we do, is we do an analysis to see what kind of a pre-earnings run do we get in these stocks. So for companies that were reporting on January 18th, like Schwab, we went back to December 28th and said, where did you close 3 weeks prior to earnings? Here was the close before earnings. Here's the close after earnings. There's your opening price, the gap up. And then what we end up doing is we take from that information, we take a look at the pre-earnings advance, which is the 3 weeks prior. What did we do from 3 weeks prior to the close leading up to earnings versus that close leading up to earnings? So we went up $10 in the 3 weeks. $10 divided into that 85.50 gives you 11.73%. So Schwab made a pre-earnings run up of 11.73%. Now, also after the earnings came out, remember, earnings were on 118 right here. So the close after the earnings are 118 on the close. There's the closing price. And then we look at, okay, well, what happened in the week after earnings? There's 125. That's 1 week after 118. That's where we closed 1 week after earnings. So you can see here's the run up before earnings. And then the week after earnings, this is the post earnings move over here. So pre-earnings, post-earnings. And then we have 3 other calculations on here. The first one is the initial reaction. That is basically just the gap up. So we're looking at where did we close and then where did we open the next morning after the earnings came out. That difference is reflected as a percentage in this column right there. Oops, there we go. So we gapped down a little bit, not a lot, but we gapped down a little bit. Now, how about the 1 day change? Well, the 1 day change is looking at the closing price after earnings versus the closing price before the earnings were released. So this is the full 1 day change. And you can see Schwab went down 3.5%. Well, then we say, well, what about from opening bell to closing bell? So starting with the gap and then to the closing bell, what did we do? Here we went down $2.75. So the open to close percentage change is based on these 2 numbers. So it went down 3%. Now, when we put together the earnings reaction portfolio, this is going to be the column that we focus on a lot. This open to close AD change. So if a company, because think about it, I mean, you're getting new information. The earnings provide new information for the market to digest. And so are you selling off or are you being accumulated? Are you being bought during the day after you've reported numbers? Now, the other thing we have to keep in mind is think about the market environment we were in mid-January. Everything was getting crushed during January. So some of this is being skewed. You have to still use common sense and still think about the market you're in. You can't always just use percentages this quarter and compare to percentages last quarter. Last quarter, we didn't have a huge sell-off like we had this quarter, right? So anyway, you can see that there's a lot of information just on Schwab here on this spreadsheet. So we do this for Schwab, and there's Goldman Sachs. That's the next one. This is all the big banks reporting to open up earnings season. Well, we've tracked everything on the 18th, the 19th, all the way up through February 4th, and all the companies. Now, obviously, when you get down to February 4th, or even any point early February, this column right here is blank. Why? Because this is the 1 week after earnings column. It hasn't been 1 week after earnings. If they reported on February 2nd, we have to wait till February 9th, which is Wednesday, to get information to put into this column. So that's why it's blank. But otherwise, there's a lot of information. So this is just the data tab. Then we have this sector report. Before I show you the sector report, let me show you how we sort by sector. So the data includes all of the various sectors and the industry groups. And so we can then copy all that data, put it in a separate tab like we've done here, and then we can sort it into the various sectors. So we can begin to look at all of this data, how the various material stocks were trading heading into earnings reports. How did they trade? How did they gap up or down? What were their average reactions with their earnings reports? Where did they close? What was that 1 day change? How did they perform in the week after earnings? All of these things are provided right here on this tab, and here's your average. So when you're looking at the pre-earnings advance of all of the material stocks, they averaged a pre-earnings run of minus 5.51%. Keep in mind, again, look at the dates. They're all January. So if they're all January, we know January was brutal for the market. So this is being skewed a little bit because every company that is included on this list reported in January. We didn't have any February reports in here. Okay. So minus 5.51%. Let's go back to that sector report, because materials, if you come across right here, there's that minus 5.51%. There's your average pre-earnings run. 5 stocks went higher, 14 went lower heading into earnings over the 3 weeks. So not very many went up, and the average of all 19 of them were a loss of 5.5%. So what worked? Look at energy. Now, of course, energy was going up while the market was going down. Energy's been going higher. So this shouldn't be a huge surprise. All 11 energy companies that reported. So let's go back over here and let's take a look at those energy companies. Here they are. So here are the 11 companies that reported, all in January, and they all made good runs. Here is that pre-earnings advance column right here. So there's your 9.5%. All 11, this one signals that it was a positive change. If it's a negative change, like over here, you see these minuses, it comes up as a 0 here. So that's how we're tracking. So all 11 showed positive moves in a positive pre-earnings runs heading into earnings. Anyway, so you go back to the sector report, and you can then break down. You can look at the pre-earnings runs by sector. How about opening gaps by sector? Daily change by sector, intraday move by sector. You can do all of these things and take a look at how these different sectors performed. What I found interesting is that the opening gaps, the average for energy, they averaged gapping up 1.58% with earnings. So that was after they had this pre-earnings move. They still were the best performing sector in terms of post earnings, the initial move to the upside the next morning. 9 out of 11 gapped up, and the average gap up was 1.58%. Where you see the big green numbers, that's just telling you that that sector was the best in that category. The big red numbers tell you that was the worst. So here, technology, you can see going on this pre-earnings run, technology was getting killed in January. So of course their pre-earnings run was bad, right? 6 companies gained on a pre-earnings run. 43 went down. So you might say, well, what 6 companies were actually rising into their earnings? Well, we got that information for you. Go back here, find technology. And this is technology right here, starting with software, all these. So which ones gained? Well, there's your ones. So Ericsson, telecom equipment. NXGN, that's a software company, gained 1.1%. Another telecom equipment company here gained. GLW. Scrolling down, the next one, CLS, electrical components. The 5th one, another software. That was Team Atlassian. And then the final one was FICO, another software company. So all these were the only ones that went up heading into their earnings report. So the 3 weeks leading up to earnings, there were only 6 out of 43. There's the total. So only 6 went up. That means 43 went down. And that's where it's all summarized. So there's a lot of summary, a lot of top tier information shared here. And then if you want, you're looking at it, you're like, wow, wonder what happened with this group, or, industrials, 32 or lower, only 4 were higher. Which 4 went up? What about these daily changes? Or maybe consumer staples. Look at the daily change. This is from one day to the next. Consumer staples was the best performer. The intraday move. So from the opening bell to the closing bell, all 9 consumer staples companies went up. That's pretty amazing when you consider that in total, 126 went up, 189 went down. So there was an overwhelming number of companies that went down during the day instead of up after earnings were reported. Consumer staples, all 9 from opening bell to closing bell went up. Where do you think Wall Street was repositioning its money during the day? I think that's pretty clear. It was in consumer staples, right? How about the worst performing group on average? Technology. Where's the money been coming out of? Technology. During earnings, 30 out of 49 companies went down from opening bell to closing bell. So anyway, I think this is great information. You can go through all these various tabs. You see all the different columns that we have here. We have a tab. So if you wanted to look at the daily change, you go to the sort by daily change tab. And with that, you can see all of the information. Here's that 1 day change. And you can look at the numbers from top to bottom. A ton of information and research that we do for our members at Earnings Beats. So anyway, that's kind of where we are. And that's about where I want to end this. I'm going to wrap up with the earnings reaction portfolio, because essentially what we're going to do is we're going to be looking at this intraday move. And on this intraday move, this is kind of where the research starts for the earnings reaction portfolio. I'm going to go through all of this and then decide. And I'm not just taking the top 10 earnings reactions. First of all, you would get 4 software companies, which obviously would be very skewed. Instead, I'm going to be looking at these companies that have strong AD. It could be that some of these are 4%, and I might look at the chart and I might look at the relative strength, and I might say, hey, KLAC is one that we want to put into our into our earnings reaction portfolio. It had a positive reaction, and I also like these other things as well. Now, I can tell you, we just started the earnings reaction portfolio last quarter, this past quarter. And we're not really tracking it on our website. And I even announced at the time, I said, this is just an experimental thing. This kind of makes sense to me that these companies that are doing well after their earnings probably should continue to do well. But it didn't. They didn't. It was not a good quarter. And a lot of it was because we stick mostly with growth stocks, and growth stocks have been obliterated. Keep in mind, we started this back at the beginning of November. I think it was November 10th. And if you look at when growth stocks started really getting slammed, it was right about that exact same time. So I'm not giving up on the portfolio. I can tell you the portfolios have been awful this quarter. I mean, it is what it is. I mean, we look at growth stocks. I believe over a long period of time, growth stocks are going to wildly outperform the S&P 500, and they have for the most part. But last year, February to May, growth stocks got absolutely slammed. And this quarter, they have been absolutely slammed again. And so anybody who's trying to invest in growth, if you look at any growth mutual fund, now, if it's large cap, probably isn't going to be doing quite as bad as some of the others, because large cap did hold up better than most. But yeah, we need to continue to focus on what we do well, and just realize that there are going to be periods of time when the market just doesn't cooperate, and the themes that we may be interested in or that we follow just are not themes that Wall Street's interested in. And right now, with inflation and interest rates doing what they're doing, and the forecasts and where they're likely to go over the next few months, I think it's going to continue to be a challenging environment for growth stocks. But that's not going to change or keep us from putting what we believe are some of the best growth stocks into these portfolios. Because quite honestly, I can't tell you when we're going to get the turn to the upside. We might get that sign. We might get a signal that kind of starts beating us over the head that says growth stocks are great. But right now they're bad, and I think they're going to continue to be bad. All right. Anyway, as I mentioned earlier, I just want to mention one more time before we get into any questions. The earnings reaction portfolio, which was originally going to be done on the 10th of February, we're going to hold off and we're going to do it the 21st, along with the other 4 portfolios that we do. So we're just going to get them in sync and just have them all together at the same time. And so we will be announcing those at the same time we announce the model portfolio, the aggressive, the income, and the strong AD portfolios. So that'll be on Monday, February 21st. The market is closed that day. And so that should be a great day without any distractions in the market. All right. I don't know if we have any questions, John, but take a few minutes.
Okay. A couple questions. Here's a combo. How far back do we need to go to check the relative strength before the earnings, and how often is the data updated?
Well, this data right here on the spreadsheet is updated every day. I mean, Matt's staying with it. You know, we update it on our website, or we'll try to keep it updated on our website, the spreadsheet, once a week. So it'll be on the weekends. But the actual updating takes place every day that, when we get some new earnings. So we'll leave, like if we go back to the data, so we'll still be leaving all of this on here, but we'll simply be down here at the bottom as we go through and we have more information. We've already got these all listed out. So once the information starts coming out, we'll be filling out the spreadsheet. So that'll be done on a regular basis and updated and sent to members weekly. As far as what to look for on relative strength, how far to go back, I think it's a case by case basis. I mean, I don't think there's, stock charts only gives us, certain predefined time periods to go back. So we can go back and look at a week. We can go back and look at a month. We can go back and look at 3 months. I don't know that I would necessarily be going back more than 3 months. I don't know that the relative strength that took place 6 months ago is necessarily going to help us with what's going on in the market right now. But I do think, maybe either 1 or 3 months. I would be using those two. When you pull up the chart list in summary form, I would be using either the 1 month or the 3 month to take a look and sort the relative strength and then go from there.
Okay. This was from earlier. We downloaded each day's company's earnings, 5 days, 401 to 405. How can we combine all 5 days together to see what you showed? An example.
Well, I mean, you can take all of that data. Let me go back to the spreadsheets or to the chart list. I mean, I'm not quite sure what the question is, but I think, here are the upcoming earnings. I've got 5 different chart lists. There's 2.7. We've got 2.8, 2.9. I mean, if you edit the list, I mean, you can take this and you can copy this to another chart list. I mean, you can add all these charts to other chart lists. The problem is your numbers are going to start to jumble and you're not even going to know which day they report, because on this chart list on the 7th, they start 1001, 1002. If we go to the next one, which is 27 after the market closes to 28 before, we have 001 for the Monday afternoon, and then we go down to 1001, 1002. That's Tuesday morning. So if we combine Mondays with Tuesdays, all of a sudden you're going to have charts with the same number, and these are all absolute charts. This is not going to give you the relative strength charts. That's why we did this relative strength separately. So the relative strength includes all 5 days. And it also has it sorted by Monday, Monday morning, Monday afternoon, Tuesday morning. That starts with the twos. 2,500 starts Tuesday afternoon, wherever that is, right here. And then 3,000, you go to Wednesday with 3,000. 3,500 takes us to Wednesday evening, and so on and so forth. So I'm not quite sure what the question was, but if you put all those other, Monday through Friday, 5 chart lists together, they all are numbered similarly. So you're just going to have a mess. You're going to have 5 different charts with 1,000 on it, for instance. So like that 27 BMO. So 1001 is the first one. That's Tyson. Well, if you put all 5 days together, you're going to have 1001 from Tuesday, from Wednesday, from Thursday, and from Friday. You're going to have 5 charts with the same 1001. So I'm not sure if I'm answering your question. I'm just rambling, hoping that something I'm saying is making sense.
Okay. We always get this question. Generally, if I'm correct, when you display one of your Excel spreadsheets, we've tended to make those available to annual members. Is that the case here?
Yes, they'll be available on the website. And I mean, you saw the amount of data, and I mean, it is tremendous amount of work that goes into this. And then once you have it, you might have other ideas on how you want to sort it, or you might want to insert another column and go through and do your research. Maybe there's you want to see how it performed 1 week before earnings. That's just an example, but I mean, you could do anything you want with this spreadsheet. A lot of it's already set up for you. So yeah, I mean, there's a lot that you could do to do some additional research if you're interested.
All right, let's wrap up with this one. A lot of useful information. Thank you. Assume you want to put 10% of your capital into 5 companies. What are the process steps you would take to select those 5 companies in the current market environment?
Yeah, in this current environment, I wouldn't be putting 10 stocks or 10% into 5 companies, period. I mean, if you're putting it in and you're saying, hey, my long-term horizon, I'm thinking about buying 5 stocks and I'm going to hold them the next 10 years, then yeah, I think trying to, whether you buy them now or whether you buy them in 3 months probably is not going to be a huge factor. And if I'm wrong and the market were to take off and you didn't buy today, then you'd have to go buy them more expensive. So it depends on your time frame. If you're looking at, well, I might buy, these 5 companies today, or I might buy them in March or April or May, I'd say, for me, I think the odds would be better to wait. Or, maybe you buy, if you're going to do 10%, maybe you do 2% in February, 2%, in each one of these companies in March, another 2% in April, 2% in May, 2% in June, until you get up to that level, and you're just slowly getting in methodically. So if the market goes down, you're getting some cheaper shares, kind of an average dollar cost kind of a thing, or dollar cost averaging. Anyway, as far as which 5 companies, my gosh, I would definitely be looking at the long-term charts. And it comes down to what kind of an investor are you? Are you aggressive? Is this money going to make or break you in 10 years? This 10%, these chunks, is this, 50% of all of your investments? Or is this a small piece of something you just, want to kind of play around with, play money? I mean, to me, that makes a big difference as to what I would be selecting. If you're telling me, this is, first of all, it's probably not a good idea for most people to be putting that kind of percentage of their entire portfolio into any one stock. I might do it, but I'm kind of crazy like that. I generally wouldn't suggest that most people do that. But anyway, if it were me, because the question was, what would I do? I personally have a number of companies that I like, and I would probably be going through those companies, thinking more from a long-term perspective, not buying 10% today for the next 60 days, but buying 10% today that, maybe in 10 years. I would start that list with Tesla. I've said it before. I love Tesla. I think they are the leader. I think they are today's Apple. Where Apple was 20 years ago, I think that's where Tesla is today, or maybe 10 years ago with Apple. I think Tesla will be the most valued. I think it's going to be the biggest company in the world. Just my opinion. You're asking for me for my opinion. That would be one. I would probably spread it around in some different sectors and different industry groups, but I would focus, again, this is me, I would focus on the aggressive sectors. I would not be looking at Kimberly-Clark or Kellogg or some of the companies like that that are more defensive oriented. I would be looking at aggressive because I believe the stock market's going up a lot over the next 10 years. So I would focus on the Teslas. I would be looking at the companies like Apple, Microsoft. I mean, the boring companies. But if I knew I had to hold them for 10 years, I want to know I'm in very, very solid companies. If you wanted to take a shot with some more aggressive companies, and maybe one of them absolutely explodes and you're going to, make a fortune on one of those companies. I mean, some of these software companies in a growth environment, I think some of these software companies that truly make it, think about Microsoft where it was 30 years ago, 20 years ago. Think about Adobe Systems where it was 20 years ago. I mean, you've got companies that have made huge, huge runs. So if there are some favorites among software companies, I would be looking at companies like Datadog, DDOG. I mean, I'm not saying that's the one, but that's one that I personally like. And I'm just kind of watching it and letting it get taken down, taken behind the shed and beaten. And I'm hoping at some point when the market's ready to turn, I can get into some of these stocks that I think are going to explode to the upside. So a long answer to a very short question, but I think there are so many variables to that question and so many, everybody's in a different, financial situation. It has completely different financial goals and are different points in their lives and, might have families that they're providing for. Others might be single and, willing to, throw caution to the wind. I mean, everybody's different. And so it's definitely not a one size fits all kind of question.
Okay, I think that does it, Tom.
All right, that is it. I appreciate everybody tuning in. We do have some great events coming up. Next one is on Saturday. I know a lot of you or many of you in here today or listening on this recording later are probably going to be free members, but I'm telling you, the event that we have this Saturday, the anatomy of cyclical bear markets, is going to be worth the price of admission. By the way, the price of admission is $0 for a 30-day trial. So wouldn't have to be much to be worth that. But anyway, I think it's going to be a great event. I think if you are worried about what happens during cyclical bear markets, this webinar on Saturday is going to be for you. So sign up, come see me on Saturday. We'll go through this. I'm going to go through a lot of prior rough periods during markets, both bear markets, secular bear markets and cyclical bear markets, show you the differences and some of the things I'm expecting as we go throughout the course of 2022. All right. Appreciate everybody tuning in. And again, hopefully see you up during my shows 4 times a week, Mondays through Thursdays, 9 a.m. Eastern, Trading Places Live. Make sure you check out my blogs. I love to try and educate within our service and also outside our services as well. Anyhow, have a great night, everybody. Happy trading.